Happy Friday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Friday, May 3rd, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what to specifically do about them in your portfolio, you need to be a client of 42 Macro. So today's key macro events are a well-timed Goldilocks jobs report supports our J wants a soft landing theme, but the ISM services PMI screams stagflation. So the nuance there is the April jobs report supported our resilient U.S. economy theme via accelerations in the growth rates of private sector employment, private sector average weekly hours, private sector labor income, labor supply, and the employment diffusion index. The report was unsupportive of our sticky inflation themes via decelerations in the growth rates of private sector average hourly earnings and temporary employment, and an acceleration in the growth rate of cyclical unemployment, as well as minor increases in the headline unemployment rate and the underemployment rate, with the latter four time series indicating more slack in the labor market. In terms of market implications, the April jobs report had a decidedly Goldilocks feel to it, i.e. not too hot to support the no landing scenario and the tightening of financial conditions that will likely come with rising duration risk, and not too cold to support the hard landing scenario and the tightening of financial conditions that will likely come with rising credit risk. The ISM Services PMI did its best stagflation impression by supporting our sticky inflation theme and marginally disconfirming our resilient U.S. economy theme. This week's barrage of conflicting signals suggests asset markets may struggle for direction until the April CPI report on the 15th. As always, transitioning to our 42 macro dashboard here, client dashboard. We'll wrap it up here with the question from our community. This one reads, has Bitcoin already priced in Treasury's intentions? It says, hello, Skipper. I'm trying to distill the incredible amount of data that your superhuman brain crunches and comments on and what it means for risk assets over the next 1 to 3 months. That's a really nice compliment. Thank you. Would I be right in saying that the crypto markets, especially Bitcoin, have already priced in Yellen's intentions to tighten financial conditions in her attempt to get CPI lower before the election? And the downside for crypto is probably less than equities. It seems that Bitcoin at least has almost become a leading indicator for liquidity and risk assets. So a few things there. So Bitcoin typically is a leading indicator for broader risk assets. It's a lot more assets that are further out on the risk spectrum are more responsive to fluctuations in liquidity and those types of conditions, those sort of leading to coincident drivers of asset markets. And so any triple C credit, Bitcoin, those kinds of market exposures will generally be leading of more broader market exposures that are closer or further in on the risk curve, like U.S. equities. So that's step one there. In terms of what the Bitcoin market is priced in. So I'm not of the view that certainly I don't have the ability to ascertain whether asset markets or have I priced something in fully or not. I don't think I've met a lot of the world's best investors throughout my 15-year career on Wall Street. Many of them are clients of 42 Macro. And I don't know that I've met anyone that has the ability to look at a price chart and tell you if something's priced in. What we can do as investors, however, is understand and quantify momentum, quantify changes in volatility regimes. And that's what we do daily with our volatility, just a momentum signal here at 42 Macro. And so we know just based on our study of momentum, what the crypto market thinks about the prices. We know based on the study of the change in volatility, based on we know based on the change in volatility, what the crypto market thinks about the incoming information and how that's confirming or disconfirming some of the legacy views that have built that price momentum. And so we did have a meaningful change in the Bitcoin signal. I want to say maybe a week or so ago. So that's something to be aware of as an investor. I won't tell you if it's up or down, but certainly that's something to be aware of. So in our opinion, it's not about trying to say this is priced in or that's priced in, because again, nobody has a crystal ball. Markets don't talk. They're like your dogs. Actually, no, I think dogs are more communicative than asset markets. I think an asset market's more like a wall. The wall only says what you put on it. And so at the end of the day, what's priced into any given asset market is probably more a reflection of how you feel or what your process suggests to feel if it's a more dispassionate, quantitatively driven process like ours is here at 42 Macro. And then lastly, with respect to Yellen and tightening financial conditions, we talked about this earlier in the week. It seems like Jay and Janet, Fed and Treasury are now kind of rowing the policy boat in opposite directions right now. for much of the past 6 months, they have been rowing the policy boat in the same direction in terms of implementing dovish monetary policy vis-a-vis forward guidance and dovish net financing policy. And now the net financing policy side of that equation is no longer as supportive and is likely to get hawkish. It is going to get hawkish over the next kind of 4 to 6 months here. So that's something just to be aware of as an investor. How to reconcile that, I don't know if I have a crystal ball on the right answer there, and I don't even think we need to, because at the end of the day, investing should not be about how you feel in today about Jay and Janet, kind of having a little divorce here. Investing should be responding to signals. Have your signals change. And if the signals change, then you should change your positioning. And more importantly, and this is the last thing I'll end on here, if your signals do not change your position. This is the kind of week that a lot of volume and transactional happen in the asset markets. And you'll see a lot of turnover because a lot of people are rushing to put on new trades or close existing trades because they think they have new data. But the reality is you shouldn't be reacting to new data. That's noise most of the time. You should be reacting to new signal. And if there's no clear change in signal, then you should not have a clear change in your positioning. So just be aware of that. Some top end institutional risk management knowledge there for you there. So everyone have a wonderful Friday. Have a great weekend. Best of luck out there. We'll catch you back here next week. And then 42 Macro Clients, we'll have our May 2024 macro scouting report presentation in your inbox this afternoon, so you can continue staying ahead of the crowd out there in asset markets. Appreciate you. Cheers.